Good afternoon. Since the May meeting of the Monetary Policy Committee, near-term indicators point to weaker than anticipated global economic activity. Global financial conditions have eased as central banks in advanced economies signaled a move towards monetary accommodation. However, downside risks remain and are dominated by escalating trade and geopolitical tensions. In the domestic economy, GDP contracted in the first quarter due to a combination of supply-side and demand-side factors. Monthly inflation outcomes have stayed around the midpoint of the inflation target range, as food and services price inflation remained subdued. The medium-term inflation outlook is unchanged. The year-on-year inflation rate as measured by the Consumer Price Index for all urban areas was 4.5% in May, up from 4.4% in April. Goods price inflation was 4.2%, while services price inflation was 4.6%. The bank's measure of core inflation, which excludes food, fuel, and electricity, was 4.1%. Producer price inflation for final manufactured goods decreased to 6.4%, compared to 6.5% in April. The inflation forecast generated by the SARB's quarterly projection model, the QPM, is for headline inflation to average 4.4% in 2019. The projections for 2020 and 2021 remain unchanged at 5.1% and 4.6% respectively. Headline CPI inflation is expected to peak at 5.4% in the first quarter of 2020 and settle at 4.5% in the last two quarters of 2021. The forecast for core inflation is lower at 4.4% in 2019 and 4.7% in 2020 and is unchanged at 4.5% in 2021. Electricity, food, and fuel price inflation have shaped the trend in headline inflation. The assumptions for Brent crude oil in the QPM have been revised down from $69 to $67 per barrel for 2019. The assumptions for 2020 and 2021 are unchanged at $68 per barrel. Fuel price inflation is expected to average 3.2% in 2019 and to peak at 13.1% in the first quarter of 2020. Food price inflation has continued to surprise on the downside. It is expected to start rising from the end of 2019 and to peak at 5.6% in the second and third quarters of 2020. Inflation expectations have continued to moderate. According to the Bureau for Economic Research second quarter survey, expectations are for headline inflation of 4.8% in 2019. Inflation expectations for 2020 and 2021 eased to 5% and 5.2% respectively. 5-year ahead inflation expectations remain unchanged at a historic low of 5.1%. The inflation expectations of market analysts in the July 2019 Reuters Econometer survey have been revised lower to 4.5% in 2019 and 5% in 2020 and remain unchanged at 5% for 2021. Market-based expectations implicit in the break-even inflation rate have declined significantly since our last meeting, reflecting a firmer exchange rate and subdued domestic and global inflation pressures. 5-year break-even rates decreased to 4.5% and 10-year break-even rates decreased to 5.3%, the lowest level since January 2015. Global GDP is expected to average 3.3% in 2019 and stabilize around 3.5% from 2020. While global growth remains relatively healthy overall, recent indicators on trade and manufacturing have deteriorated sharply, and a range of downside risks to growth remain. Growth in world trade volumes contracted for the fifth consecutive month, declining by 2.1% in April 2019. Trade tensions remain heightened, weighing on market confidence and lowering investment. Other upside risks include geopolitical developments and high levels of corporate and sovereign debt. Across most countries, there is limited policy space to respond to shocks. Inflation outcomes and inflation expectations in most advanced economies remain below targeted levels. Recent communication by the Federal Reserve Bank and the European Central Bank indicate that in the absence of significant shocks, monetary policy will remain accommodative over the medium term. However, market expectations of the extent of future central bank actions appear high, creating the risk of significant market volatility should this not materialize. Emerging market currencies are firmer, reflecting a combination of US dollar weakness and shifting market sentiment. Country-specific factors remain important, with currencies of countries with stronger macroeconomic fundamentals having fared better. Since the May MPC, the rand has appreciated by 3.3% against the US dollar, by 2.4% against the euro, and by 2.3% on a trade-weighted basis. The implied starting point for the rand is 14 rands 30 against the US dollar, compared with 14 rands 40 at the time of the previous meeting. At these levels, the QPM assesses the rand to remain slightly undervalued. While the rand has benefited from improved sentiment towards riskier assets, it underperformed its emerging market peers due to idiosyncratic factors. Domestic growth prospects and fiscal risks rate high amongst investor concerns. GDP contracted by 3.2% in the first quarter, reflecting weakness in most sectors of the economy. The sharp quarterly decline was primarily caused by electricity shortages and strikes that fed into broader weakness in investment, household consumption, and employment growth. Based on recent short-term indicators for the mining and manufacturing sectors, a rebound in GDP is expected in the second quarter of 2019. Continued low business confidence remains a concern for the MPC. The Absa Purchasing Managers Index averaged 46.3 points in the second quarter, remaining below the neutral level. The RMB BER Business Confidence Index remains unchanged at 28 points. The SARB's composite leading business indicator continued to trend lower. The SARB now expects growth for 2019 to average 0.6%. The forecast for 2020 and 2021 is unchanged at 1.8% and 2% respectively. The MPC assesses the risks to the growth forecast to be balanced in the near term, but remains concerned about longer-term risks. Investment prospects will continue to be limited in the absence of structural reforms. The escalation of trade tensions could have further negative impacts. While some cyclical factors constrained recent GDP growth outcomes, the committee remains of the view that current challenges facing the economy are primarily structural in nature and cannot be resolved by monetary policy alone. The implementation of prudent macroeconomic policies, together with structural reforms that raise potential growth and lower the cost structure of the economy, remains urgent. The MPC welcomes the continued downward trend in recent inflation outcomes and the moderation in inflation expectations of about 1 percentage point since 2016. The committee would like to see inflation remain close to the midpoint of the inflation target range on a more sustained basis, with inflation expectations also anchored around these levels. The overall risks to the inflation outlook are assessed to be largely balanced. Demand-side pressures are subdued. Wages and rental prices are expected to increase at moderate rates, and global inflation should remain low. In the absence of shocks, relative exchange rate stability is expected to continue. However, the impact of upside risks to the inflation outlook could be significant. Global financial conditions can abruptly tighten due to small shifts in inflation outlooks in advanced economies and changing market sentiment. Domestically, the financing needs of state-owned enterprises could place further upward pressure on the currency and long-term market interest rates for all borrowers. Food, electricity, and water prices also remain important risks to the inflation outlook. Against this backdrop, the MPC unanimously decided to reduce the repurchase rate by 25 basis points to 6.5% per annum with effect from 19 July 2019. Monetary policy actions will continue to focus on anchoring inflation expectations near the midpoint of the inflation target range in the interest of balanced and sustainable growth. In this persistently uncertain environment, future policy decisions will continue to be highly data dependent, sensitive to the assessment of the balance of risks to the outlook, and will seek to look through temporary price shocks. The implied path of policy rates generated by the quarterly projection model was for a one cut of 25 basis points to the repo rate by the end of the fourth quarter of 2019. The endogenous interest rate path is built into the growth and inflation forecast. The implied path remains a broad policy guide which could change in either direction from meeting to meeting in response to new developments and changing risks. This concludes our statement, and at this stage, I would like to invite you to pose any questions that you might have, and I will make sure that my esteemed panel here responds to your questions. Yes, ma'am.
Afternoon, Governor. I'm Khalambata from Bloomberg News. Was a 50 basis point cut discussed? And if so, what was the reasoning to only cut by 25 basis points? And my second question is, wage negotiations have started in the mining sector, and we know that's been an industry that's been quite volatile when it comes to wage discussions. Is the SARB at all concerned about above inflation wage increases in that particular industry?
Thanks, Amokela. Yes, sir.
Good day. The name is Mfuneko from Reuters News. I wanted to ask the committee whether or not there is an ideal interest rate level that the bank thinks about, especially in light of the growth circumstances and the trajectory in which growth is going. And just a related question, does the bank see the country's growth prospects and potential growth as having gone fundamentally lower from perhaps a couple of quarters or even a couple of years ago? Thanks.
Is that it? Okay. Amokela, the discussion was whether to cut by 25 basis points or to keep rates the same. And after much deliberation, we decided that the correct thing to do is to cut by 25 basis points. There was no discussion of a 50 basis point cut. Wage negotiations and settlements, we always got concerned about wage settlements that are above or outside of the inflation target. Whether they are in one industry or the other, it is a general concern, so we will not isolate a particular industry. Ideally, wages increases should be anchored closer to the midpoint, and to the extent that wages rise faster than inflation and they are compensated by a rise in productivity, that is okay. So if you get wage increases of 10% and productivity is growing by 12 or 15%, it's okay. That can't be inflationary, because you get the benefits of productivity gains from that. But we know that we have not seen productivity growth of those kinds of magnitude. Mfuneko, is there an ideal interest rate level that the bank looks at or targets? We target inflation, not the interest rates. Interest rates are a tool to achieve price stability. And so the approach can't be that this is the ideal level of interest rates. That said, economists talk of what is a neutral real interest rate. And that neutral real interest rate is that interest rate at which inflation does not accelerate and the economy is growing at steady state. And so that would be the ideal, but we know that we are not at steady state. At the moment, we estimate the neutral real rate to be around 2%, and you must understand what is meant here. I said real, which means after taking account of inflation and country risk premia. So that is how we think about the interest rate. So you could see then, which then takes to your next question, that level of neutral real rate is influenced by what your potential growth is and how well you are performing with respect to inflation relative to the target that you have set for yourself. So you've got to consider all of those factors in arriving at that. It is not a static figure. That figure moves as country risk premium move and as your potential growth changes. So it gets affected. By those. Our potential growth rate has come down. You might recall that getting into the 2007, 2008, at that time, the estimates for potential growth in South Africa was between 4.3 and 4.6, depending on which methodology you use to estimate potential growth rate. Potential growth rate has since eroded significantly and is bubbling around the 1% mark at the moment. And it is important that you have raised that question, because that is the most important growth to actually look at, the potential growth rate. And the potential growth rate cannot be changed by cyclical policies. The potential growth rate gets changed by investment in the skills base of the country. It gets increased by an investment in the capital stock of the country, and so forth. And so that is what is important, the potential growth rate. This other growth that gets reported all the time, the actual growth outcomes have got to be measured relative to what the potential growth rate of the economy is. So monetary policy and to some extent fiscal policy, which are basically cyclical policies, can affect actual growth around the cycles, but they will not change the long-term potential growth rate of the economy. That needs structural policy to change. Sir and Sir.
Thank you, Governor. I'm John McCory from Bloomberg News. You said in your talk that there is a global downside risk from the high levels of sovereign and corporate debt, and that the ability, the policy space to respond to shocks is limited. What's the bank's assessment of the risk from the sovereign and corporate debt levels here in South Africa, and what's the assessment of South Africa's policy space to respond to such a risk?
Lukanya.
Hi, Governor. It's Lukanya Mnyanda here from Business Day. My memory might be failing me a bit, but I think I don't remember you talking about fiscal risks in such explicit ways before. So I'm just wondering if there's been any new developments that made you especially worried now on the fiscal space of things. And secondly, whether based on that you've had any views or any updated views on the risk of a potential downgrade, and if that were to come, what would be the impact on, whether you have a view on the impact there, therefore then on South African markets and therefore the inflation outlook.
Mfuneko again from Reuters News. Just a follow-up. So you spoke about the real rate being at around 2%. When you looked at that real rate, did you consider it?
I didn't say the real rate. I said real neutral rate.
Real neutral rate, yes. Yes. Looking at that rate, and then did you consider that rate against the neutral rate of other emerging currencies, and consider whether or not investors might be comparing those kind of rates? And then the second question is, what exactly do you hope that 25 basis point cut? What kind of impact do you hope it will have in the short term, cyclical term that you spoke about? Thanks.
Chris, how neutral are you? Can you deal with the neutral rate of and how we compare with other countries? DG Naidu, fiscal risks and potential ratings downgrade, and how we think about this, and whether we have mentioned fiscal risks before. My hunch is that we did. That is that. And Nomfundo, the impact of the 25 basis points rate cut on the economic outlook. Okay? Chris.
Thanks. Look, strictly speaking, we don't compare our neutral real rate to other emerging markets. We have done work in the past which has compared it. We've done a little bit of research on this. The finding tends to be the neutral real rates have fallen around the world, including for emerging markets and also for South Africa. But one has to be a bit cautious about how one interprets that, because emerging market economies are quite diverse, and so when you unpack a neutral real rate for any particular economy, its structure will play a big role there. So some economies that are highly exposed or highly dependent on commodity exports, like South Africa, will have a neutral real rate fall with commodity prices falling. But other emerging markets that are not very commodity dependent, for instance, will experience less of a decline in neutral real interest rates. So idiosyncratic domestic economy factors for each economy matter a lot for neutral real interest rates and how they compare. It's more true across advanced economies. The neutral real interest rates have come down across the board. And there are, again, a variety of factors that have contributed to that. Some of the big ones are demographics and lower investment, and obviously lower inflation. We do compare in the last monetary policy review our real rates relative to a range of emerging market real rates over time, it's somewhere near the end of the monetary policy review, and we sit right in the middle of the pack. There are a wide range of emerging markets that have much higher real interest rates than South Africa, and a few that have lower real interest rates. So we sit right around the median.
Okay, Rashad, I have not forgotten about you. I just forgot to give you your question. Your question is going to be on the high levels of corporate and sovereign debt, and in our assessment, how does South Africa compare and whether it poses risks for us. But Naidu, shall you deal with the fiscal risks and potential downgrades?
Thanks, Governor. Thanks, Lukhanyo. I'm sure we have mentioned fiscal risks before. Public sector borrowing puts pressure on the interest rate that the economy borrows at. Right? Public sector borrowing, because government is so large, because state-owned enterprises are so large, it does influence the price of capital in the market, and therefore is a significant determinant of what the interest rate for the person or business in the street is there, out there. So in that sense, we do take it into account. Significant additional public sector borrowing does have the risk to push up interest rates, long-term interest rates in particular, and that has an impact on the price of capital. And so in some ways, the monetary transmission mechanism is influenced by the level of debt and the level of the public deficit. That's not unique to South Africa, that's true for every country in the world. We don't make an explicit call about the level of debt or the level of the deficit, but we're merely pointing out that this is one of the risks that faces the capital markets. There is a risk of a downgrade, there's no doubt about it. It is not in our base scenario. We think that we are likely to have a stable ratings going forward. And hopefully in a year or two we can start to reverse some of the downward trends in ratings from some of the rating agencies that have taken us below the investment line. So I think if you take a 2 to 3 year view, there is as much risk of a downgrade as there is of an upgrade by one or two of the rating agencies. It's not in our base scenario that there will be a downgrade. It is a risk, though.
Fundi?
Thank you. So what is the impact of a 25 basis points cut to interest rates? So like a good economist, I'd have to say it depends on what else happens. So if you take the 25 basis points cut on its own, this will have a marginal effect by supporting consumption and investment decisions on the margin. And the one thing that we've highlighted as the MPC is that while we see some cyclical factors, a lot of these arise from supply-side constraints that have been there in the economy for a long time. So policy uncertainty has been there for the last while. There have been concerns about various policy settings, and this has had an impact on business confidence, investment, and employment outcomes. So the way that this comes through is that you start to see household consumptions declining, and you start to see firms delaying their investment decisions. So to some extent, for our 25 basis points to have a significant impact, this must be complemented by other structural reforms that deal with these underlying issues in the economy. So when the governor was talking about improving the potential growth rate, we think that that's something that is quite important. But if you just take the impact of monetary policy alone, it will have a temporary effect that will fizzle out over time if it's not complemented by other measures.
Thank you very much. One of the reasons why we flag corporate debt as a concern has to do partly with the fact that under easy financial conditions, if corporates are leveraging, that's one thing. But if conditions change, corporates could be in trouble. And I think where the major weak point is when you look at emerging markets. Many emerging markets have high corporate debt, particularly denominated in hard currency. That, fortunately, is not an issue in South Africa. Our non-financial corporates actually have reasonably healthy balance sheets. So that is kind of less of a risk for South Africa's non-financial corporate sector, but is a risk for many other corporate sectors. The one area that obviously is a big issue is that over the period of easy money, many emerging markets, South Africa included, accumulated a lot of debt, and the big question is, what happens when financial conditions tighten? And in this sense, we take a view that policy space is limited from the point of view that there's very little policy space if you take monetary policy and fiscal policy combined, and that if anything needs to be done to deal with some of the risk to debt, we've been saying ad nauseum that it has to be some other parts of the economy, structural reform, and so on. Thank you.
Okay, just to add what Fundi was saying about the impact of the 25 basis point cut, bear in mind, Mfuneko, that the forecast that we have has embedded in it a 25 basis point cut in the fourth quarter of this year. What the decision achieved today was to bring that cut forward to today. So the forecast that we have presented has in it a cut that was going to take place in the fourth quarter of the year. So the question that we might then end up having to ask is, well, if that didn't materialize, what would have your growth forecast had been? And unfortunately, I do not have an answer for you for that one. I have an answer for you for what we said was going to happen. Any other questions here? Webcast.
We have 4 questions, Governor, but one of which you and Fundi have covered already. The one question is from Guy Frost at Spectra. If the rand strengthens much more from here, will you or are you already starting to accumulate US dollars in reserves? And Standard Chartered, Razia Khan, which is the one you and Fundi have covered, are you concerned about the transmission of monetary policy that 25 basis points on its own might not achieve very much? Peter Montalto. Governor, in previous statements, you always mentioned that the stance of the monetary policy was broadly accommodative, but you have not mentioned it this time. What is the stance now after the cut? Dutch Bank, Danali Masaya. Governor, what then explains the rising neutral real rates when your potential growth estimates have now been revised lower this year and global neutral rates seem to be falling?
I think we have answered neutral real rates, but Chris, you might want to do a rejoinder to deal with that other bit. Rashad, how do you characterize the stance after this cut? It's an interesting question. After we have cut, surely the new stance should be accommodative. I mean, after cutting, it can't be that the new stance is restrictive. But you are a better teacher than I am, so you could handle that. So can we deal with those, and then I will deal with the accumulation question.
Yeah. Look, I think that the adjustments to potential growth and the ones that came through on the neutral real interest rate are essentially marginal. We didn't factor in global easing on our neutral real interest rate estimate yet because it actually hasn't happened. And so there's nothing really to factor in there. So the neutral real rate in our forecast hasn't actually come down with this meeting. The potential growth is slightly lower, and that's a function of the Q1 outcome. But again, it's pretty marginal, and you'd have to have much larger movements in any of these to feed through into what the model tells you about policy guidance.
Hi, Peter. I think that when we talked about in the May statement that the stance is broadly accommodative, I think that what we were conveying is that we are operating in a margin of error where, in fact, you could make the argument that monetary policy is slightly loose, slightly tight. It's not excessively loose, excessively tight. And I think that by cutting, we still maintain that we kind of more or less where we want monetary policy to be. And it's not just by characterizing it as in accommodation mode or not. We obviously looking at, as you know, the neutral interest rate against the equilibrium neutral rate, and we know, our attempt to kind of characterize monetary policy is partly that, based on that criteria, but it's based on much more. So I think our decision to cut now is partly hinges on the fact that those dynamics between what is your neutral rate estimated versus the actual neutral rate it doesn't change fundamentally from the last meeting, but what does change to some extent is how you think about downside risk to inflation and so on. So it's this is how I would kind of characterize it. Thank you.
Thank you very much, Guy from Spectra. The accumulation of reserves has got nothing to do with the level of the exchange rate. We have stated before that we will accumulate reserves to the extent that the country experiences lumpy inflows of capital. So if there is a big FDI transaction and which could result in a dislocation in domestic foreign exchange markets, we go into the market and we would trim off probably not all of it, but significant parts of that in order to build on the reserves. And that had been the practice. That is what we do. Because you see, if you say that the exchange rate is stronger, therefore I must go and accumulate reserves, you seem to suggest that you know what the correct market exchange rate should be. And I do not think that central banks are particularly good at deciding what the correct exchange rate should be. And when they tried to fix one, they had come out second best and became very costly for them. Are there any further questions? Lucanio, is that the last one? Yes, Lucanio is the last one.
Hi, Governor. That's the last one. I just noticed that you have an empty chair there, and I was just wondering with the changes in the committee whether you're going to... There should be 2 empty chairs, actually. I'm just wondering if you're going to fill those up anytime soon, like in terms of expanding the MPC.
It was a mistake. I told them not to put a chair there because there are 5 of us. No, the terms of reference of the MPC states that we can have up to 8 members. Traditionally, we had kept that number at 7. So we will find the other 2. Based on the fact that the governor and the deputy governors are by law part of the MPC, they are the ones who have to make interest rate decisions. The others have to be staff members of the bank, and that process is underway, and hopefully we will find people to fill those positions. Okay, thank you very much. That concludes the business of today. We'll see you in September.